Good morning, everybody. Welcome back to the Everyday Growth Advisors live stream. It's a Monday morning. I hope you guys are having a great day so far. Ready with your coffee and ready to go for this market breakdown. We have some interesting things happening and developments. You know what? In hindsight now, I should have done a little better of an analysis, and I think it is what it is. Okay, so it is safe to say that I have overlooked something pretty massive. But you know what? We live and we learn. And it's funny that I didn't see this because I was talking about it with, a bunch of people over the past 2 weeks, but I didn't really think it was happening. And then I realized what has happened. Now, there is good news and there is bad news. So I spent a good amount of time during the weekend doing some research. Welcome into the stream, guys, by the way. I hope you're having a great day so far. This one will be an interesting stream because you get to learn from my mistakes in real time. And yep, we all make mistakes. So I definitely made a mistake. And I'm not afraid to admit it because, to be honest, we all learn. And if you don't make mistakes, how are you going to become better, right? So let me break this down so that you guys can get an understanding. So there is good news and bad news, okay? And I'm about to break it down. So the first thing we'll do here is break down the news as usual. We'll get through the whole thing as our normal market updates, and then after which I'm gonna show you what happened and what I overlooked. Okay. I think there was a cognitive bias that kind of didn't allow me to see this, but I'm glad that I've recognized it in the end, because I was still trying to figure it out, and now I have figured it out, and I feel much better about it. So let's get this done. So first things first here, let's have a look at the news. Markets are finally flashing red, right? And this is what it's standard operating procedure. When everything's sold off and everything's red, then they tell you to sell, right? Then they say stocks are tumbling and treasuries are rising, and there is a fresh something about virus cases risking, and Goldman says value, not cyclicals, would rally most on vaccine, and yada yada yada. Okay, this is great. Like, this is exactly what they want retail to think, and this is exactly the moment where you have to ignore the news. All right, believe me, this is the moment you ignore the news, because this is the moment where they want to mislead you. All right. This moment here, and actually this week is going to be an important week. Okay. And I'm going to get to this in a second. I'll tell you why this week is going to be an important week. It's because we're going to make a defining decision on where the market wants to go. And I'll show you what I mean by this, because, honestly, I didn't see this neither. It was like one of those things that were a little difficult to realize, but then I overlooked it very slightly, and I'm very, very happy that I have found the smoking gun. Okay, so with the news here, something about leak files on bank suspect, China ride hailing something to partner with another something. Nikola founder resigns. That was a big one, right? We were laughing about this one. This is the reason why I don't invest in companies like this. People keep asking me, should I buy Nikola stock? Should I buy this? I'm like, dude, you don't have any intrinsic value for the stock. Why? It doesn't have a track record, right? Look at what happens, right? They had a SEC probe, and now the founder is out. He resigned. That's including the bunch of nonsense that he's been posting on Twitter. This is not a good sign for a business like that, okay? Obviously, this stock is going to be demolished right now. I don't even need to look at it to tell you that. It's absolutely going to be demolished. Yep, opening up more than, I don't know, what is this? $10 down, $10 on $30. That's a third of the stock value gone overnight just on the news. So we're talking about a 30% drop. And this is the reason why I never trade stocks that are in this kind of a pattern, right? Buy-ups like crazy, goes to $90, comes down to $30, goes up to $50, comes down. This is not a healthy stock to trade, okay? So yeah, okay, anyway, besides this fact. And then what else do we have? Apart from that, okay, not much on Bloomberg. But Bloomberg is flashing red, right? It's saying, run for the hills, everything's dying, we're gonna go into another 20% drop. Stock futures point to acceleration in S&P 500 losses. VIX is going up. We're gonna die again, right? As HSBC stock hits 25-year low. Crude prices fall. Oh no! Wall Street back exchange to launch as rival to NYSE. Okay. Oh, that's interesting. Retail rallying. Blah blah blah. Okay. Okay. You get the idea. The idea is the news is telling you to sell, right? The news is telling you that more bad things are about to approach. All right, and that's what do we do when that happens, guys? In the chat, what do we do? For people of you who have been around here in this live stream for a long time, what do we do when the news tells us to sell? And by the way, if you're here and you want to show some love to the stream, just help me out by smashing the like button. Or lightly tap it if you're not in the mood to smash it. But either or, if you can click the thumbs up, you know, it really helps me out a lot for this video to reach other people. I'm really hoping that we can reach 100 likes today. So I would really appreciate that very much. So you hold and buy, hold, okay. There's a whole bunch of things, right? You hold. You definitely don't sell anything at this point, right? You gotta. This is your time to shine. Okay, this is your time to shine. All right. But now there are a couple of things over here that I'm going to cover. All right. Before we get into the breakdown and all that. All right. Let's look at the pre-market movers here. So Nikola, yeah, down 27% here. Apple down 2%. Okay. Tesla up about 1.8% on battery day. NEO also moving down 2%. Actually, that's weird. It should move in tandem with Tesla. That's kind of interesting. The Fed is Powell's going to speak today. The chairman, and then a bunch of FOMC members are going to speak today as well. Now, I don't really expect much of an outcome over here. I think if anything, it's going to cause the markets to be a little more jittery. So be careful today. Definitely be on the watch for things like that. Okay. Oracle up 3% on approval of the TikTok acquisition. Roku up 2%, and the rest of them relatively down. Okay, so looking at the SPY technical update here. Now, if you realize something, we are now in a kind of a bearish territory. Okay, I'm not saying we're in a bear market. We're approaching a very important technical recession, retracement, not recession, technical retracement. Okay. We had you see these impulsive and corrective waves. Impulse, corrective, impulse, corrective, impulse, corrective, right? Impulse, corrective, impulse. And now expect the corrective wave to be a little deeper, right? Now, I was thinking we may bounce on the 50 moving average until I started to look at the broader time frames, and I don't understand how I missed this. But a retracement here makes most sense. Okay, obviously we're not going to do one of these, right? But a retracement down, you know, from the highs where we were irrationally bought up to a profound level of at least this or the 50 moving average somewhere here is more likely now. Okay, and then I was also looking at a sector seasonal rotation. I think it was seasonal charts. This is the one. And look at what happens to the S&P 500 futures seasonally over the past 30 years. Okay, and you can see the markets tend to do a little bit of a sideways movement, and then in September and October tends to drop. And this comes ahead of the December rally. Okay, this is where we are at right now. All right, so what comes after this is a rally, right? And include that with the elections, include that with a bunch of other things. But the thing is, even after figuring this out, I was kind of pissed at myself because I was wondering what was the cause of this. Okay, what caused this? What caused this depression? And I cannot believe what I missed out on. Okay, it was actually something so fundamental that I didn't follow. It is nothing other than a sector rotation. Okay. Now, I know many of you are thinking, what the hell is he talking about? Well, the thing is, you have to realize something. All indexes are down, right? All indexes are down. So you have to first ask yourself, what the heck happened? Well, the thing is, we have to first understand what caused this rally. This huge rally that we had, right before this drop. I'm talking about after COVID. This is like below here is where COVID was, right? And then we had the COVID drop, and then we had a strong rally, irrational rally that was very, very great, right, for all of us. And you have to ask yourself what caused the rally. Well, if you're looking at the S&P 500, it's made out of roughly about 500 plus companies, right? But what actually only caused this rally were probably 5 to 6 companies that make up majority of the market cap, right? They make up majority of the market cap. What are those companies? We had companies like the Microsoft, Apple, right? Google, Amazon, Facebook, Netflix, right? You had all those stocks that rallied big time, okay? And these were what contributed to the S&P 500's huge rally, right? Why? Because these were your COVID-free stocks. They didn't get affected, but in fact benefited from COVID, right? Microsoft benefited from COVID. Apple benefited from COVID. Why? They had the biggest blowout quarterly revenue, with services revenue pushing. Even iPhone sales weren't that bad, right? To the point where the stock rallied to $500 and they stock split, and people still bought into the rally. Okay, this is the reason why I told you I got out of Apple. Why? Because it was overvalued. Google benefits from people staying home, increased search results, right? Amazon, we don't need to talk about Amazon. Amazon benefits directly from this one. It's crazy the amount of things they benefit from, right? Facebook, with a bunch of people sitting at home, what they're going to do? They're going to consume more social media, right? Netflix, do I really need to explain, right? You have Zoom, you have a lot of different stocks. Okay, now Zoom obviously doesn't have that big of a market cap and doesn't make a big percentage. But these single-handedly make up the majority of the weight allocation of S&P 500. Okay, so all of these stocks rallied into oblivion. Now, what happens is we made a decent penny here on this drop. And I thought that we will bounce somewhere here to go back up on the 150 moving average. But what I didn't realize is that the profit taking wasn't over yet. In fact, people are continually taking profits. The rally was so strong that people started to take profits on these specific companies, okay? And since they make up the majority of the index, it causes the market to go into a corrective territory. It's such a simple thing that I overlooked, okay? Now, how do I know and how do I find this information? Well, look at the 1 month performance of the S&P 500 here. What is red? Microsoft, Apple, Facebook, Google, Amazon, okay, a bunch of others, right? You can see a bunch of others here, whatever, right? EA, Netflix, right? Look at what is up. Semiconductors are up. Banks are up. Medical devices are up. Restaurants and travel are up. And industrials are up. Basic materials are up. And beverages are up. What does this mean? This means that investors are starting to price in a reopening of our economy. And the funny thing is, I mentioned this on the live stream a couple of months back. I said, when the market is about to moon, it's gonna sell off. And I didn't realize that this was the point. I thought this was a short correction, and now I'm starting to get, well, the good thing, so the bad news is this. I have a couple of positions that are gonna be completely washes. The good thing is I now know what is going on for me to benefit from this, okay? So I'm going to have a short-term loss, but a long-term gain on stocks that I own, but on the short term for some of my option contracts, the ones that are especially expiring in October, I'm actually going to watch them. What I mean to say is I'm going to actually let them run the way they are. Some of them are really doing badly. And so what I'm going to do is let them run and recover on a impulse wave up from where we are. I'm going to get rid of them. Okay. So I'm going to wait for one of these and then get rid of my positions somewhere where we go to an impulse, because this is eventually going to come down. This will go up. We'll try to retrace back, right? So the bad news is I didn't see what I was talking about for months, and I didn't recognize that this was the drop that we needed. That is the bad news. The good news is my mistake is now your gain. Okay? My mistake is now your gain. So I recommend that this is the time where you got to understand that everybody is, well, institutions have taken a bunch of profit on the leading tech stocks, which are making up majority of the indexes. Okay, so that causes a corrective a wave down on the major indexes. That's why you can see NASDAQ is the one that's hit the hardest, right? It's hit the hardest. Think about it. Okay, the Dow Jones in comparison is actually a bleak correction. Think about it. Look at this, right? And so now the next thing is, does this mean that we go in and buy a whole bunch of things right now? No, it does not mean that. Okay, what I see now, and I think this is really gonna kind of help me out a little bit better as well, help you out as well. This is the beauty of it, right? Obviously, I can't be 100% right all the time, and you know what? Sometimes you're right, sometimes you're wrong. As long as you take the risk in the right time and you don't overextend yourself, you'll be okay. Like the positions that I had open were only about 7 to 8% of my portfolio, right? I still remain long on a bunch of other things. I have shares. I sell. What I'm doing in efforts to, combat this is I'm selling covered calls, right? Selling covered calls. Jeez. Covered calls on the stocks that I own, and in addition to that, I'm thinking that if this goes a little lower, then I'll start to buy calls on the companies that I really like as well. Okay. To offset the ones that I have. Basically, I'll do a roll, right? It's going to be like a roll. So this is kind of what I'm seeing, okay? Now, how many of you guys understand and agree with me on what my analysis is? Because to be honest, this was in my opinion, I shouldn't have overlooked this. It was a pretty simple thing, to see that the profit taking was what was causing the market to come down, okay? And as I said, sometimes this just is difficult to look at when you're just concentrating on a bunch of different things. And I'm just happy that I caught it right now where we are at the bottom. It's better late than never. Okay, so now where do we start to enter these positions? There is on the weekly is what I'm looking at here. Okay, so this is what I want to highlight here. So drawing a fib here, a retracement first of all. We can see that we have to go down to this level here. This is our previous pivot point. So you can see this was your previous pivot from the low to the high here. So that's your A, that's your B, okay, for your Fibonacci retracement. And tomorrow we'll be doing a webinar on Fibonacci retracement. So I hope you will attend that webinar. I'll be diving deep into how to do these and what you're supposed to look for, etc., etc. So now what we're looking at here is a 38.2 or 23.6 bounce. I think the 23.6 is possible, but I personally don't think we'll get there on the Nasdaq. But it of course it could happen. That's, as I said, when people get irrational and buy up, they get irrational and sell off too. So there is two sides of the market that are constantly battling each other. It's the bulls and the bears. The bulls are constantly getting irrationally positive, and then the bears are getting irrationally negative, right? So that's one thing to notice, okay? Now, the thing is that retail investors, see, this is the reason why I say you got to be really careful, right? Everybody, I'm sure that at least, 5 friends or 6 friends who were asking you when Apple stock split was going to happen. They were saying, hey, should we buy the Apple stock split? And I can guarantee you that at least 1 or 2 of your friends bought Apple at this price here, okay? And what would have happened is after this drop, they're feeling extremely terrible about themselves because of the decision they made. And I can tell you that out of those friends that you have, the same friends that bought up here are gonna sell down here. Okay, they're gonna sell because they don't understand market dynamics, right? But in fact, they should understand. And if you have a friend that's done something like this, you should tell them that this is the moment that you average down, right? Why? Do you see Apple going down anywhere? Do you see Apple, failing as a business? Absolutely not. So your investment thesis should be intact, right? And so this gives you an opportunity to buy more Apple at a cheaper price, right? It's a cheaper price. So your best favorite stocks are now on a discount. This is the time where you can start to purchase, but you can't just do that just yet. Okay, so for Apple, I'm gonna say the ideal purchase price is still gonna be somewhere around this region here. This is what I think would be a good price to buy it at. I'm not saying we will get this price. Intrinsic valuation stays about $100 right now. That's what I calculated. It's between $90 to $100. This is the region which Apple is a buy right here. Okay, so we're quickly approaching that valuation. Whether we get there is a different thing, right? As for then you have what else? You have Microsoft, right? This stock is now undervalued. This stock has an intrinsic valuation of 210 to 220 and 230 on the high side. So this stock is undervalued. This is, in my opinion, adding Microsoft, anywhere below this level here is nice, right? It's also approaching this nice little demand zone here. This would be the levels to start picking it up at 190 plus. This would be the good price to get it, right? And then you have Amazon. Amazon's valuation is much higher, right? And this one's also undervalued, but this would be your region to start buying, right? At about the 2,700, 2,600, this region here. I would honestly, even if you get it at 2,800, it's still a good buy. Okay, so you could buy within this region, right? So what we want to really wait for here is a confirmation, that we are finished selling off. We don't have that right now, so unfortunately, the only thing you can do right now is to wait, right? You can wait. Now, would you buy hedges here? Would you buy VIX here? Would you buy puts here? The thing is, I think, in my opinion, the risk to reward opportunity there is already lost. If you were to choose to buy VIX here, or you were to choose to buy puts on SPY, you're overpaying for those contracts. Okay, so I personally don't want to make the same mistake twice, and so I personally think it's not a good idea to do so. I think the best thing you can do right now is wait for this week to play out. Okay, this week is an important week because if we actually, for some reason, close above this 50 moving average this week, okay, if we can do one of these and close above here this week, within these next 5 days, above the 61.8 Fibonacci retracement, then we may have a shot at going back up to all-time high. Okay, but remember, we have to sell off before we can get there. So it's going to be a tough situation. Okay, you're going to have to do some butt clenching and really be patient here. That's what I got to say. Now, having said that, my positions are also looking a little painful. But actually, out of all of them, I'm not really that bothered by any one of them except for my Microsoft position. And so my Microsoft position is the only one that what I'm going to do is and the reason for why I'm bothered about the Microsoft position is because there are 220 calls. There are 220 calls for 1016. And I'm starting to get the idea that this might not be enough of time, even though we have a month left over, less than a month, we have 3 weeks. I'm starting to think that, it might not be enough of time for Microsoft to make a rebound for me to gain back intrinsic value on my contracts. Okay, so what I may choose to do here is wash these contracts off and pick up some longer term contracts and then add a massive position in there to cover back any losses that I made. Okay, so this is the way I'm going to deal with the situation. The best way to deal with the situation is purchase on the first sign that we have a reversal and then double down on my position. That way you're kind of exposing yourself a little more, but then you have to risk the reward opportunity to make up for the lost that I had. Okay. And I think it's right now I'm at a minus 48% on my Microsoft position. So it's going to be, to be honest, it wasn't even that much. It's like $2,000. So I'm down 1,000. The hedge covered for that, right? Part of that. Honestly, all in all, even through this drop that we had, the hedge covers majority of my losses that I have right now, even after buying so late. Okay. So but the thing is, I hate the fact that I didn't see this coming. That's what irritates me. Okay. I have major OCD, and so these kinds of things really tick me off. It's like I didn't notice this fine detail that I should have, and you know what? It is what it is, right? So you guys get to profit from my mishap, and sometimes that's why I say it pays to attend the stream, because if I make a mistake, you get to benefit from it. If I make a profit, you get to benefit from it. There's literally no way you don't benefit from coming to this live stream, okay? So thank you for tuning in, and I appreciate you taking your time being here. Make sure you smash the like button or lightly tap it, whichever you feel is possible for you. I really hope that we can get to 100 likes today. It would really be awesome if we could do that. This is me reaching out to tell you that, hey, even I'm not bulletproof, okay? I'm a human. I make mistakes, and this is how it is. The stock market is a complex cog of systems, and even me being in my master's program, doing this and that, and having 7 years of experience, sometimes you miss the most obvious things. Okay, so anyway, what the thing that I was talking about here was things have flowed out of tech, right? So where are they going? Well, majority of the money has been recently flowing into industrials. You can see all the things that are cyclicals, right? Cyclicals are what are rallying right now. So you have your Starbucks, McDonald's, right? You have Logitech, your Las Vegas Sands, all those things. Basic materials here, even Triple M, stocks like Triple M have been rallying, right? And so majority of these things have been going up and up and up. And the market is starting to price in for the idea that the market's going to open up again. Okay, so that's the simplest way to look at it. See, one thing is, I could have honestly come into this stream and told you guys, oh yeah, look, this is what I found, and oh, I'm benefiting from this. But the truth is, at the end of the day, if I did that, I'm doing a disservice to this stream. Okay. My number one priority of running Everyday Growth Advisors is to always be open and honest about what I take and what I do, because that is what is important to me. At the end of the day, if your portfolio is not making more than the S&P 500 in the end of the year, I don't know why you're trading. You should just buy the S&P 500, right? And so I actively believe in that, okay? And so it is important for me to make sure that I back up what I'm doing with honesty and respect for the people who are viewing the stream. Okay. All right. Let's see what people have to say in the comments here. Good morning, guys. Good morning. Hey, just London. Exactly. Yep. Exactly. Bye. Look for opportunities. Read the market, not the trend. Absolutely. Everything on sale. Yep. That's pretty true. Buy, discount. Yep. I agree then, Nelson. Go long, impulse, tech hype, and stock splits. Yep. Tech life is opening back up. Exactly, Melissa. That's what I was saying. Does this change your opinion on Apple? So Hassan, you have a long leap there. Now the thing is, 135, the strike might be a bit far, but I wouldn't sell this position just yet. You know what I mean? You have a bit of time on it. Why don't you wait till November or December and then make your decision? You know what I'm saying? Your contract's not going to decay that crazy. Okay. Leaps have a very short decay for now. Makes sense after the strong rally. Yep, makes complete sense. I understand. Do you think the election has little to do with the continued sell-off as well? No, not really. I don't think so. Personally, I feel like, as I was saying, I showed you this, right? Look, so when is the election going to happen? In November, right? Look what happens in November. Boom, right? So the market's starting to just, it's priced in the fact that, we're going to reopen up. And I said this, it's pretty simple, right? Think about it logically, okay? I said this on the previous stream, and I just can't, this is the thing that irritates me. It's the fact that I didn't follow my own analysis. I said, and I knew this, like I was anticipating this. I said, when the market starts to open back up, what is the first thing that will sell off? It's going to be tech. Why? Because tech has had an insane rally up, right? So at that point of time, people are going to say, oh, okay. Well, our market participants would rather say hedge fund, mutual fund. I'm talking about the big boys, right? They'll say, okay, it's time to rotate out of these and now put our money into things that will benefit from a physical presence, right? So those are all your cyclicals. So that's why I said the simplest thing was the thing that I missed. It was a sector rotation. We had a sector rotation from tech going into cyclicals, and that's exactly what I missed here. The money has been flowing secretly into all the cyclicals for the past month, okay? From Microsoft, Apple, Google, Facebook, Amazon, all this market cap that you see, which was responsible for the tech rally, right, is now flowing into financials, into semiconductors, into some software, into some, look at this, right? Majority of these over here, right? Majority of these are all cyclicals. Okay, and medical, right? So that's the basic idea. Elections doesn't really have much to do with it, to be honest. Kramer says a lot of it has to do with the fund managers selling stocks to buy into new IPOs like Snowflake. Nah, not really. I don't agree with Kramer. I'm sorry. Time soon for Microsoft leaps. Absolutely, I agree with that one. Morning from New Jersey. Welcome in, Richard. Let's like this video because of its honesty. Thank you, man. I appreciate that. Easy mistake, T. Thanks for letting us know and yet again giving us the game. Thank you, Ryan. I mean, I try my best. Is it too late to get into calls from other sectors? At this point, why would you want to buy into the green when you can buy into the red, right? So what I say right now, Valerie, is I think for this week, you really need to take a chill and wait to see what the market does here. Okay, I know that I hate doing this. In fact, I'm not telling you to react to the market. What I'm telling you is start anticipating the bottoming. Okay, so we don't want to react. We want to anticipate here. Okay, and how we're gonna exactly do that is not by catching the bottom, but by waiting for a sign that we're gonna start to make higher highs and higher lows, right? Once we start doing this and then this and then this, right? That second wave entry is going to be the main thing here, right? So remember, let's say we're in this down, like this down, right? What we want to see is this and then this and then this and then this, right? And once you see this, then your entry is going to be somewhere here, right? You want the two higher highs and the two higher lows. Okay? That's what we want here. So, for now, I say you can't try to bet to the downside. It's too late. And you can't try to catch the bottom for the upside unless you want to ease into your position. You want to get one here, and then one later, and then one later. You could do that, right? You could do that. That's another option. Okay. I'm in Baba, 300 calls, 10, 16. Think there's still enough time. Possibly, but as I said, we have to be patient. I believe I'm holding a similar contract. Can you show us where we are based on your curve graph on showing where we are headed? What do you mean by this? Can you show us where we are based on your curve graph on showing where we are headed? Which curve graph? Should I cut my Apple 125 call 1016, which is down 70%? Oof, that's a tough one. Let's see. 125. Yeah, I mean, okay, I wouldn't cut it right here though. Honestly, what I would do is wait for an impulsive wave again, and it will come. Believe me, it will come. Believe me, even though this sell-off is happening quite badly, right? You can wait for a little bit of an impulse wave and then sell off that contract, right? So wait for the rebound on S&P 500 and Nasdaq. There will be one, okay? There will be one. It's when it's gonna happen, okay? Wait for the rebound and then sell it off, and then roll it over into a further option. We appreciate you, no problem. Would it be fair to say fintech, automation, and genomic stocks will be on the come up as all of this settle down? Yeah, possibly. Possibly. I would think so. So yeah, it would be interesting. Apple 140 call for this. I have one now, and I think I should hold it, but this market is tough. Yeah, Jason, I hear you. I would hold it for now, the same as this guy up here. Hold that for now, wait for the impulsive wave, and then cut it, right? And then roll it out to a shorter strike. That's what I would do. Your strike is a bit far. That's what I would say. Can we get a couple of people to smash the like button? I'm not sure if you guys can, but it would be cool. Okay, I want to now pause on the questions and the live stream, and I hope that was helpful for you guys. Right now, as I said, what we're going to be waiting for is a retracement to 100% here. That would be a key level. And then on the Dow Jones, we have possibly a bounce on the 200 and 150 EMA here. On the S&P 500, we're looking at about the same thing, a bounce on the 150 EMA on the daily. And on the NASDAQ, we're looking at a bigger drop here. So imagine if S&P 500 and all those come down, others are going to come down with it. That's what we're looking at right now. Okay. So that will be, there's something to watch. Okay. But right now, I want to cover the ticker of the week, Disney, which is what we are covering for this week. Now, I know it's probably a terrible time to cover the stock, but let's anyway cover it because we need to know whether this business is a buy when the time is right. Okay. So technical analysis wise, this stock is doing pretty okay. I know it looks pretty nasty. Let me take off my indicators here real quick. Oops. Okay, cool. So I'm looking at 4 hourly. This is going to be your long-term trend on Disney, right? And what I do see here, if Disney were to come down with the entire market, and we're already at this point, by the way, this was the point that I saw us bouncing in the short term. The 61.8 golden ratio, which is, I'm going to talk about more about this tomorrow, which is also coinciding with the bottom of this channel. We're actually going to open up here. So we're already here basically, right? That will be a short impulsive wave today to try and cover this gap, and then we should see a further sell-off here. So the 61.8 fib retracement here is a strong level for a support if you look at it. Now, realistically speaking, there's also a gap below here from the 123-ish to 117 that needs closing. Okay. Now, I don't know if Disney's actually going to drop all the way there. That would be actually pretty terrible. But we'll see what happens. I think the first level, that if it breaks to 61.8, then we're going to go down to 122 and then to 117, and then we'll take the elevator down to 113. So these are the levels at which Disney will come down to if the market irrationally sells off further, right? And there's a high chance, okay? There's a high chance for that if we continue down this channel. Okay, we're in a bearish trend. You can see it here. Now, the thing is that this business is actually a pretty good business. The economy is not a market graph. Okay, yeah, I got you. You mean this one, the sector rotations graph. You mean this one. The funny thing is, if you look at where we are, obviously we were at the market top, right? Okay, and at the market top, the things to invest in were basic materials, energy, and staples. But energy has been a freaking terrible sector this year, right? And honestly, this is the reason why I actually want to invest in energy. But the thing is that with all these green initiatives, it makes it difficult. Now, this is not really considered a bear market. So this actually doesn't really apply because this is a long-term trend of the market, right? We're talking about a big cycle here. But sector rotation-wise, healthcare, staples, and energy were the buy and is the buy, right? And then so right now, what you should be looking at should be utilities, finance, and healthcare, because this would be considered late stage. we're about to reverse, right? But remember, this is a full cycle, okay? But this is not a short-term bear cycle. This is a long-term bear cycle, okay? And during the bull market, the things to get it were technology, industrials, and basic materials. The problem is that this doesn't apply because of the way COVID has disproportionately affected these sectors, right? Think about it. Industrials hasn't recovered, basic materials barely recovering. Tech is the one that held up the entire market, okay? And energy is not performing as well because why? It's one of the ones that have been hit by COVID, right? What is directly correlated with energy? It's oil prices. And so these are all underperforming. Lack of supply, lack of demand, oversupply, lack of demand. That's why energy is suffering, right? Actually, I dare say it might be a good time to start looking at energy because, things like XOM, we've been talking, we did an analysis on XOM. I think, this is where it starts to bottom out, to be honest. This is where it starts to bottom out. This may be the point where we get a big bounce, especially since people are starting to get optimistic about, the economy, okay? We covered XOM, we were about to buy it, and then it did a dip and closed us out, and we hit a stop loss, and, that was it, right? And now we can see this. In fact, this would be a really nice trade to take a little put spread here. You could do a put spread if you wanted, sell some puts, right? People who are thinking it's going to go further down, right? And then at the same time, maybe do a call spread up here, right? And start to take premium on both sides. That's kind of like an iron condor, if you will, but you could do a modified split if you like a butterfly, add in a call, right? Do a third leg. So you could do those kinds of things as well. There are a couple of ways you could play this. Apart from the vanilla take a leap on XOM and do like a $50 call kind of thing. Okay, so I don't want to sidetrack here. Let's get Disney done because we don't have a lot of time here. So I just want to show you this image here to show you what Disney actually owns, because this is actually insane. I was going through this with my mentees, and I just want to show you this company has an insane amount of things in its portfolio. All right, the companies that Disney owns. I'll let you have a look at this real quick because it's actually kind of insane, right? Disney owns Marvel, the entire Marvel, right? These are the amount of things in Marvel. This was an acquisition by Disney that I think it's one of its best acquisitions. The Fox Group, right? They also own National Geographic. I don't know if you know this. And then Fox Networks. This is also super important. The Fox Sports Group is owned by them. Okay. They have this group. I'm not sure what the heck this is. There's a Disney Music Group, Disney Theatrical Group, Disney ABC Group, History Channels owned by them, Vice, ABC, Lifetime, Disney Channel, right? Look at the amount of things. ABC News, ESPN, need I say more if you like sports, okay? I don't know if you guys know this, but they own all this stuff, okay? Disney Studio Services. They own Disney Channels Worldwide, UTV Software Communications, GoPro is owned by them, Photo Bucket is owned by them, Steamboat Ventures is owned by them, Walt Disney Japan, Hulu is owned by Disney. Well, they have a partial stake in it. Okay, and this is the biggest sector right now. Okay, just to cut to the chase here, this is important. This is the important segment of Disney's business right now. All right, it's called D2C, right? Okay, direct to consumer. This is the sector that they are building now, and Disney now has achieved 100 million direct to consumer subscribers. All right, across all of these ventures, Hulu, across Disney Plus, blah blah blah. All right, and that's pretty good. Okay. Now, above this, ABC Group, Walt Disney, of course, the parks and recreations, Disneyland Resort, Cruise Line, my goodness, right? Disney Corporate, okay, and then they own Walt Disney Studios, which has Pixar. Okay, a whole bunch of other stuff, and then not to mention Marvel. Marvel Studios, right? Marvel is theirs. Okay. They are obviously a brand monopoly. Okay. There's there are very few companies that can step into the economy and set up a existing business like Disney. Okay. The brand power is there. They have too many monopolistic kind of intricacies within their business. So I just wanted to show you where their revenue segments come from. They have all those revenue segments, and their revenue has been actually kind of slowing down, but it picked up sometime in December last year, and now again is slowing down because of COVID, right? So quarter over quarter, here's the play-by-play. So you can see it was growing, and then peaked out, and then boom, took a hit back again down to where we were. And so we are actually, seeing a little bit of that affect the business. Okay, we're going to do the fundamental valuation on Wednesday during our fundamental valuation stream. But apart from that, here's a snapshot of the company's finances. They're now in the negative territory for all profitability because of their performance recently, but their financial health is still okay. Debt to equity ratio is still acceptable. Interest coverage ratio is a little on the low side, but you know what? We'll give it to them. And they have sufficient assets to cover their debt right now. Okay. Growth-wise, they're still, struggling a little bit. Revenue is growing at a slower pace. Operating income's down, negative region over the past 3 years. But we'll cover more of these financials on another day. Okay. Here's the smoking gun for Disney. Okay. The main thing right now that they're concentrating on is the direct D2C business. So I pulled up the 10Q or the latest release here for the earnings third quarter for 2020. Despite ongoing challenges, we have continued to build incredible success of Disney Plus as we grow global direct-to-consumer businesses. This is the main thing that the CEO is concentrating on. The global reach of our full portfolio of direct-to-consumer services now exceeds a astounding 100 million paid subscriptions. So between all of their paid subscription, they're moving to a model where people would pay directly to them instead of paying through third parties. That's what Disney's game is right now. Because they have a brand that they are trying to benefit from. Okay, so this, I think, long term is a great move for Disney. Obviously, revenues are down big time, 42% quarter over quarter for the year. Net income, total segment operating income down big time. EPS down big time. The way the segments are performing. Parks are the ones that are taking the most hit, right? Think about that. They went from 6,500 millions, which is 6.5 billion, to less than a billion, right? Obviously, no one attending. How the heck would they make money, right? Look at the direct-to-consumer international. Look at this. Increased by 2%. So if the parks start to recover, then you can imagine that everything else starts to recover, right? So the balance should be back to where it was pre-COVID. So here's media networks. A couple of things there. I'm not going to go into it too much because we're going to do this on Wednesday. But here's the main thing here. So here's the breakdown of paid subscribers in millions for Disney, ESPN, and Hulu. 57.5 million Disney Plus users. ESPN at about 8 million. Hulu combining about 35 million. So that's about close 100 plus million, right? 80, 90, yeah, about 100, I want to say. And here's the ARU, so the average revenue per user. This is the breakdown. Revenue per paid subscriber. Yeah. Also, I don't know if you guys knew this, but Disney actually has a stake in DraftKings. They paid. I think they own about 6% of it, which is actually quite interesting. We found that out on our filing, and so see, if you don't read these documents, you don't know these things. Okay. So DraftKings actually partly belongs to Disney now, so which is interesting. I bet you guys didn't know that. And Yeah. So let's have a look at what the bears and bulls say about this company. Based on this Morningstar research that I was reading, we don't need this no more and this no more. So bulls are saying that parks and resort segments has rebounded strongly from the recession, and the opening of the Disneyland Shanghai should provide additional momentum. Additional Star Wars franchise broadens demographics that the company can address. Additionally, strong distribution and merchandising capabilities could help speed monetization of the Lucasfilm acquisition. They purchased Lucasfilm recently. Although making movies is a hit or miss business, Disney's large library of content with popular franchises and character reduces its volatility over time. Now, this is the one that I agree with the most, right? Unlike Netflix, that has to constantly churn a bunch of different, things that might or might not work. Disney has one advantage, which is its branding. Okay, and it has Marvel Studios, it has Disney characters, it has a bunch of different things that they can just keep remaking and making and remaking, and they will all be successful. Why? Because people love the content. People are in love with the Disney characters. Okay, and that's a strong thing. Netflix doesn't have that identity yet. It doesn't have the trust factor. It's like, when you think about it, it's like I watch a Disney movie because, majority of the time it's produced by Pixar. Pixar has such dope animations that you would bring your kid to watch it, right? But can you really say, like, I know Netflix is like really trying to compete in this space, but can you really say the same thing about Netflix? Not really, okay? Not really. They have that brand. They have the power there, all right? And that's what really brings them to the forefront. The business model for media networks depends on the continued. So that was what Bull says, and this is what Bears say now, right? The business model for media networks depends on the continued growth of retransmission and reverse compensation fees. Any slowdown in the growth of these fees, perhaps because the paid television begins to shrink, would hurt the profitability of the segment. Increase in the cost of popular programming such as sports and events and television series could adversely affect margins at ESPN and ABC. And developing mass market hit programs can be unpredictable, especially as media fragmentation continues. Now, I don't necessarily agree with all of this, but I think long term, Disney will hold the pricing parity against consumers. It just needs time to get there. Okay. From a technical standpoint, I think QE should wait for this to fully bottom out before taking a position here. First entry or first position here should be, sometime below this. 123 would be a nice little region to start buying a little bit of Disney and then add more if it falls further. It's already opening up at 125, so that's what we will see from this. Okay, well, that kind of concludes Disney's introduction to the market today, the new ticker Monday. Solid company, good margins, hurting through COVID. I think it's a buy long term, absolutely a buy long term. But we need to see how we can benefit from it as this market breaks down here. Now, the funny thing is, what we saw that caused the market to rally is now happening in reverse. So we have to take these opportunities as buying opportunities and not get too scared of what we are about to do. Okay. So keep that in mind, and I'll be here if you guys have some questions here for the next couple of minutes. Let me see if there was any tickers today. I feel like there was one. Kodak, $15 call, 10.16. Oops. Yeah, honestly, this is another one of those Nikola situations, man. And to be honest, I'm not down. I'm not down to trade a stock like this, man. I'm sorry, like I just wouldn't. I wouldn't touch it. It's just manipulated to the craziness. Yeah. So my recommendation is don't do that. Cool. Okay. Well, is 104 a good entry for Apple now? I wouldn't buy it at 104. It's already crossed below this territory here, so wait for it to come down here now. I think this 96 or like $100 would be. See, the thing is, I feel like it's gonna go down to close this gap. That's what I think. I think that's highly possible. Apple going down to close this gap at 95. So maybe wait till you purchase here. I wouldn't purchase right here. You know, it's dangerous. You don't know when it's going to reverse. So wait for the confirmation for Apple to do this, right? You have the impulse wave down. It's going to go up for a corrective wave, come down again, and then you'll see it start to make higher highs, right? And so then that's when you want to get in, right? It's when you can confirm that you can see that we're making higher highs. I wouldn't just buy it right now. I mean, if you want to, you could, but don't go balls deep. That's what I'm saying. My positions are in red. Should I sell and secure the funds or wait till the market bounce back? It depends on what kind of positions you have. If you have long expiries, I think you should hold them for an impulsive wave back up and then sell them. But if you're holding short-term expiries, then you might as well get rid of them right now. Oracle and Walmart is good to scalp today with the TikTok deal. Absolutely don't think so. I'm going to be staying out. I don't even want to enjoy scalping this market right now. If I'm going to scalp anything, it's going to be a bearish position. I'm not going to scalp any bullish positions today. I'm only going to scalp bearish positions. And my top picks for bearish scalping will be Amazon. And I'll be waiting for this one to drop a little more. So this will be the one that I'll scalp if it drops below this level here. The 2,900s, if it breaks down with good volume, this is the one that I want to scalp. Apple also may be the possibility. I may take Apple puts and Netflix as well. If I see it fall below this, this zone that I have here, it opens up the zone down to 440. So this is what I'll be looking at to scalp down. Absolutely do not be scalping bullish positions today. Tesla, I mean, battery day, that's what everyone's buying, right? This is the only stock that's green in the entire market. Personally, I mean, the risk to reward opportunity seems intact if you are willing to take on the risk, I guess. But you're not getting like 1:2 here or more. You're gonna get less than 1:2. So for that matter, it's kind of up to you with Tesla. Personally, I will not take it. I'll wait for after battery day and then make my move with Tesla and see what I will really want to do with the stock, because it's overvalued. I know it's overvalued. I'm not going to trade a stock that's overvalued, and that's just the way that I look at it. But this is a good buying opportunity right here. If it comes down to it, if Tesla comes down to this level here, this is where I would like to buy it, right here. So yeah. Okay then, I'll bid you guys farewell, and I'll say have a great trading day, guys. Try to be risk averse. Smash the like button on your way out if you haven't, and I'll see you guys tomorrow for the webinar on how to use fibs. I hope that you guys have a great trading day, and I'll see you tomorrow. Have a good one, guys, and peace out.